Hi, it's Friday. It's Risk and Rewards. It's a special edition of Risk and Rewards. John Authers and myself, Lisa Abramowicz. It is Jobs Day, and we got that jobs report, the payrolls report for the month of October, 530,000. It came out better than expected. Incredible data pretty much across the board with the exception of the participation rate. And what does the market do with this? I kind of think it shrugs, John.
Well, the bond market, which is the one that has been getting so excited, the one that ultimately is in the driving seat, has shrugged, and the equity market has done what it seems to always do these days. We use it as an excuse to buy. I find it hard to see anything in the numbers that really would significantly change the way one views the overall situation at the moment. I mean, if there was one more important number than any other, both because it should be and because the Fed cares about it, it's we have a chart, I think, about this, which is just the proportion of the total population that is in work. So this is excluding all the effects that come around by the participation rate of who's making themselves available or not. And this is a number that, quite rightly, the Fed does seem to care about. And you can see that at least we're now above the dreadful levels at which we flatlined in the early years of Obama after the crisis, but we're still a long way to go before getting to getting back even where we were pre-pandemic. So there's an argument there for continued dovishness. There is an argument that the Fed can at least begin the process of further normalization.
There is an argument being the key component of your statement. And one thing that really struck me about this week's Fed meeting, the fact that we got from the Fed a big dose of humility. People talk about humility. It's a big shrug. We don't know what's going on. We don't know what the economy is going to look like after everyone went home for more than a year and then came back. And during that time, the economy still operated. We don't have an understanding of what it looks like when we've reached the end of whatever this period is. So that was the underscore of the Fed's message. What does the market do with that when, frankly, it's sort of choose your own adventure of whatever people think the new normal is?
Yeah, I mean, if you want the empirical answer to what the market actually did to do with it, we've had again, markets in the long term are efficient. It's like Winston Churchill said about democracies. Democracy is the worst way of running a country that's ever been devised apart from all the others, and capital markets are the worst ways of sharing capital apart from all the others that ever been tried. Markets get it right eventually. They can be relied on to overshoot as they try to get it right. So you could just put your feet up and say, well, the bond market has overshot in both directions more than once now, and is overshot in the direction of believing that serious hawkishness would be necessary. And Jay Powell did do quite a good job of calming things down and further reducing the risk of a further of a financial accident.
So the numbers behind what you're saying, hold on a second. No, John, the numbers behind what you're saying are the 2-year bond yields in the United States, in Europe, in the United Kingdom. This is really what you're talking about, right? The round trip that we saw with everyone trying to price in more and more hikes for the Federal Reserve, for the Bank of England in particular, and for the ECB. And then they met with big pushback from central bankers saying, we don't know what's going on. Yeah, it'll be appropriate to raise rates. Not yet. Leaving everybody kind of with their own Rorschach tests, trying to figure out what that measure will actually be. But this to me is fascinating. We had a tantrum in the front end of the yield curve.
Yeah.
Now it seems to be coming back down and no one seems to care. I mean, this is the amazing thing.
Yes.
Stocks do what they do. They keep chugging upward.
I mean, I suppose you can make the other thing that's quite interesting is that we've got some confirmation that that developed markets are different from emerging markets still, because what you've just said was completely true of the developed markets. I mean, in Canada and Australia, the central banks have taken a step backwards under market pressure, but they haven't actually hiked rates. It's not true of emerging markets at all. There have been a number of large emerging market central banks that have hiked more than they wanted to because they are still under that degree of pressure. Speaking as somebody who's British, the thing that's quite interesting because the Bank of England has been showing plenty of signs of steadily becoming an emerging market central bank, given this odd status of the UK now that it's no longer part of the EU. it's quite remarkable that they seem to have misdirected the market in a classic sort of emerging market fashion. There's the chart view. Over the last month, the 2-year yield went up from 0.5 to 0.75, so basically priced in an entire extra hike, and gave it all up, mostly yesterday, when the Bank of England shocked everybody by saying, no, we're not hiking at all, after all. It's fascinating that the Bank of England could get into that kind of a miscommunication with the market. It's also somewhat intriguing that the market seems at this early stage to be letting the Bank of England off for that. This wasn't the market mishearing things. It was the Andrew Bailey, the central bank governor, saying in as many words, we will need to take action, and we've been signaling that, and this is another signal. You don't need to say things like that if you're a central banker. And
so in other words, wait, if I can understand what you're saying correctly, Are you saying that it's sort of shocking that the market's still pricing in any rate hikes this year, that perhaps that they think that any meeting is going to be live because this is going to be another rug pulling out from under your feet kind of event, if they had all of the reasons to hike rates, but just didn't pull the trigger?
Okay, I think myself, I mean, obviously you have to make the reaction that you do yesterday. It has a fairly immediate, you have to make an immediate response to that change in news. Personally, it still looks to me as though the Bank of England is going to have to hike sooner rather than later. And while the market was somewhat overexposed before, I imagine the pressure is going to build up fairly swiftly again. I guess the angles that you need to look at here, first of all, there is I was about to say minor concern, which was a stupid thing to say. There is coronavirus is picking up again in continental Europe. And we know that it is to some extent seasonal now, so it makes quite a lot of sense if you've got a meeting in December, by which point it really will be clear whether there's another winter wave, to leave it until then. And then the other point is that they care about employment, and there are 2 more UK jobs reports before their next meeting.
But John, you're raising a really good point. I mean, yes, the waiting period is really important, but you're raising such a critical issue, which is it's clear these central banks are going to hike rates, whether it's this month, whether it's next month, whether it's next, June. That does not seem to be up for debate in certain countries, in particular, the Bank of England, certainly the United Kingdom, and some people would argue the United States as well. So why is the front end so volatile if it's not the number of hikes that will be executed, and it's not whether, it's not whether they will lift off, whether they will raise rates. It's really the number of hikes and exactly, what the terminal place is that we get to, right? Yes. I mean, is that sort of what you're getting at? Why should there be these tantrums in the short end, to a 2-year in particular, if the direction seems pretty clear here?
Yes, you've just expressed that much better than I did. I think the point in terms of it's which short end as well. It's volatility in the 3-month in the UK is wholly explicable. Volatility in the 2-year, did the fact that Andrew Bailey decides and his colleagues decide they want to see a bit more, and there's no hurry, they can wait until next month to make a decision. Should that really have that big of an effect on where you think rates will be 2 years from now for the 2-year? I don't think it should. You can make sort of almost ad hominem arguments about just nobody in the bond market is used to having to consider these things because it's been such a long time since they did. But I don't quite get that. I don't know enough about the technicalities of exactly what positioning has been going on there. But it's that chart we showed you of the 2-year yield in gilts, that kind of thing just shouldn't happen. It's a sign that something is amiss when you get volatility on that scale.
And the interesting thing is you've seen, perhaps to a lesser degree, some mirroring type of a reaction in U.S. Treasury yields and 2-year yields, even though we didn't really hear anything substantive from Fed Chair Jay Powell. I mean, in terms of pushing back or not pushing back, I mean, it was sort of, we'll see what we see. It's the data. So basically letting people choose their own adventure. And it seems like the 2-year is kind of tied to the gilt 2-year yield.
Well,
more positive than I would imagine.
Look,
why should that matter?
It makes, as an anti-Brexiteer, it's maybe Britain is more influential in the world now that we've left the EU. No, that I don't believe that for a second.
I don't even want to entertain that. No, I do want to raise another issue with you, though, which is that I was speaking with Dan Suzuki of Bernstein Advisors, and he was talking about the potential bubble, or that he does see a bubble in certain areas of the equity markets. And he said, it makes sense to sell it even if you're a year too early, 2 years too early, 3 years too early. Not to get into trouble with all the people who are the bubble hunter downers and tell us that, everyone's crazy if they think that there's a bubble. This is just a new valuation. The potential catalyst is fascinating because it's literally a binary outcome on either side. Either the economy is gangbusters and amazing, and the Fed is forced to raise rates, and that torpedoes big tech and all sorts of other growth names that have done tremendously well, or we enter a recession and that torpedoes a lot of the momentum from that end. These are literally the opposite outcomes. The only way we can stay in the territory we are fostering these so-called bubbles is Goldilocks, which we remain in again and again. I find that fascinating. It's sort of, if we move out of Goldilocks, we're in, very traumatic territory. I find that amazing.
I agree. The other thing that's, I've tortured the Goldilocks analogy over the years. It's almost Goldilocks walking on a tightrope, or Goldilocks on ice. The argument I once made was that in the years after the financial crisis, that it wasn't so much not too hot, not too cold, but so cold in the economy that they can't start raising rates, but not so cold completely that the whole thing just freezes over altogether and there's no activity left. That there was this sort of strange, chillier version of Goldilocks. This time, it's very hard to work out how you stay on that path, how Goldilocks stays upright on the ice, or however you want to put it. That said, as lots of people kindly point out to me on Twitter, but it's true. I spend a lot of my time trying to work out what could go wrong, what the risks are, seeing lots of risks, telling people about them, and persuading them not to get into the stock market, which continues to go up. So, it's not as though there aren't ways through this. It's not as though there aren't ways. I also think that we do have a real inflation problem, which, in the wake of a well-handled FOMC and a dovish shock from the Bank of England, people have thought about less, but inflation didn't go away. Average hourly earnings were up 4.9%, which is a lot more than 2%. That doesn't go away as an issue.
I will say, just my one key thought, I think, from the week is that we're entering thin air when it comes to inflation, because it's not just the overall inflation number, PCE or the CPI. It's that wages have to increase at a certain pace that is faster than we would like in order for people to maintain their lifestyles, given how much prices of consumer goods have gone up.
Yes.
This, to me, is the issue, this push-pull, where you need that wage growth to be commensurate with what we're seeing at the grocery store, at the pump, et cetera, et cetera. When you start getting an unbalance there, you either enter the potential for a stagflationary light type of environment or else a hyperinflationary environment. Again, it goes to sort of like narrow window of perfection that we're in. And I just wonder what's going to tip the scales, right? I mean, are we getting more labor power with the striking, et cetera, that's going to potentially tip the scales that way? Or are we going to revert to something more normal? These are some of the big questions emerging from this week to me.
Yes, I agree with that. I'll throw in very quickly, because I think we're close for time. The other issue that bothers me is politics. And this gets to the whole issue of the legitimacy of central banks and how we want to control central banks. We do want them to be independent of day-to-day politics, but we do want them also to be accountable. Jay Powell, if we take the analogy from 8 years ago when Barack Obama thinks about taking Larry Summers, who is unpopular with many progressives in the Democratic, and then goes with the more palatable choice of Janet Yellen, the female already senior figure within the Fed. The similarities with the dynamics now, Jay Powell and Lael Brainard, are very close. The arguments I made about Powell's and Larry Summers' reasons why they might be disliked by progressives, and the reasons people might have liked Janet Yellen or Lael Brainard, both of whom are perfectly well qualified, but none of that has anything to do with the actual problems that we confront at the moment. And that is a very alarming disconnect that we're about to make. Well, Joe Biden and then the Senate are about to make a very big decision, and it's basically going to be made almost without any regard to what we've just been talking about for the last 15 minutes.
We have so much more to talk about. We are completely out of time, and then some. We will have to pick it up next week. Thank you so much, and have a great weekend, John.